Hello and welcome to the creme de la creme of our pre-budget shows, the Big Budget Brainstorm. Well, the markets appear to absolutely welcome the budget brainstorm bang on the day when CNBC TV 18 chooses to have its markets brainstorm. The markets have signaled the pre-budget rally. Over a 1% gain in all the indices, 2.5% if you looked at Nifty Bank, and 8,600 touched by the Nifty just on the day when we meet here for the Big Budget Brainstorm. I have with me the creme de la creme of market experts to tell us precisely this. Why is the market rallying? What do markets want from the budget? I have with me Navneet Munot, who heads the asset management company at State Bank of India Mutual Fund. I have Aditya Narain, an independent market expert now and had headed the City research team for a very long time. Prabhat Awasthi of Nomura, again heading the research team there, and Mr. Sudhir Kapadia, the head of the National Tax Partner for Ernst & Young, to give us the tax angles that the markets will watch out for in this budget. This is a crucial budget, as we know. There are several firsts. The date itself is a first of February. No railway budget, a first in that sense. No plan, non-plan divisions. That's a first. And of course, it comes before the big GST, when the nation will become one tax arena. And that also means several firsts for this budget. Well, without much ado, markets starting their pre-budget rally. So that really is the first question to my guests. Navneet, what do markets want from the budget for this rally to remain as well hydrated as it was today?
So it's just one of the events, apart from several other things that the government can do during the year. So even last year, when you look back, you had several big bang reforms. If I start with the bankruptcy code, if you look at the GST, the other taxation reforms, look at the setting up of the monetary policy committee, the Aadhaar bill, so on and so forth, the real estate regulatory bill, so on and so forth. And I expect that that pace will continue even going into 2017. But looking at some of the other events recently, where you had a new regime in the United States, which has talked about a very steep tax rate cut. So if US is talking about a 15-20%, I'm sure India will also have to pay attention to it, because that will be followed by several other countries in the world. If you also want to leverage fully on what we have done in terms of the demonetization and everything else to increase the tax to GDP ratio, one is the cutting tax rate, but also simplifying the tax regime. When you talk about the ease of doing business, the ease of calculating and paying your taxes should also be an important thing. So we can discuss more about that. And
okay,
another
so
thing,
one thing the markets want for this rally to continue, for the good cheer to continue: cut taxes, simplify taxes.
I think also keeping the fiscal deficit under check.
Okay, I'll come to that in a bit. I want your first, the most important thing that
simplify the tax regime, invest more money in infrastructure. Maybe if I can add.
All right,
too.
Sure.
Yeah.
Okay, and of course, you spoke about fiscal deficit. We'll come to that. Aditya, the one thing the markets want, okay, I will allow two things the markets want for this rally to remain hydrated.
The way I see it is the government has taken a big and aggressive political call through demonetization and with GST that is impending. And both of these are disruptive to some extent. There has been some pushback on that. So I think where the market is being hopeful is that they're looking for some messaging in economic terms, but which will be political in terms of either tax support or some kind of a uniform basic income or something that actually builds on the hard work that has been done. So it's interesting to note that there's been much more reform in the last 6 to 18 months than you've seen at any point in time. The fruits of those reforms are still not effectively playing through, either in economic terms or in terms of the individual feeling so much better. So I think what the expectation is here, to some extent, you massage challenges that you faced, but also try and seek and build on it. So tax would be one of them. Thinking of the uniform basic income could be another one.
Okay. Well, we got two messages, different ones, uniform basic income and infrastructure. We'll come to both those in a bit. But since both of you have said that you want a massage through taxes, let me straight away handle that question, Prabhat. The one big negative or the fear for the markets is short-term capital gains. So if that short-term capital gains is increased from, say, 15 to 20%, would that be something that can disrupt this superb cheer that we see?
I think short term for sure, if you get a tax increase in markets, there will be a short term reaction. But I think it sort of remains to be seen as to how deep it will be, because market usually will adjust one time for this kind of event. It will not be something it will hang on for a long time, and you cannot see that in sort of isolation alone. For example, if you're going to 25% tax rate, let's say on corporates over a period of time, that is a 5% boost in earnings effectively. So if the tax rationalization is, the entire is part of a gamut of things which makes sense to the market, then I don't think you might see that kind of reaction. Also remember that long term probably is also equally important in terms of tax rates, because effectively by taking out Mauritius Treaty and Singapore Treaty, you essentially have introduced much larger portion of participants in the markets are paying a much larger short-term capital gains, no impact on the market. So the fact is that a bunch of FIIs who are paying no taxes so far are starting to pay taxes, has had no impact on the market. I think a small percentage increase might not sort of alone cause the market to derail.
Okay, 15 to 20 will not disrupt the market. But before I come to Sudhir for more complex questions, Navneet, what if short term is not 1 year but 2 years?
I think if you have a year where economy is growing at 9%, corporate profitability is growing at 15%, markets are doing well, global investors are putting money, domestic investors are quite enthused, that could be a good environment to do that. I think given that in next couple of years, huge amount of divestment needs to happen. And if the market sentiments are not good, global investors, I mean, maybe till couple of months back, we were the only oasis of hope for the world. But today, you look around the world, US markets are doing well, UK is doing well despite Brexit. I think this year European equities could do well despite all the political challenges. Some of the other commodity producing countries are doing well. So I think we have to face that competition for the global flows also. So maybe I think it can wait for some more time.
Okay. Shubh bolna hai, so I don't know whether I should ask you about 3 years, 1 to 3, that would be a killer. A no-no. If short term were defined as 3 years.
I think that will clearly hurt. But I think you have to look at it in another perspective. There was a point in time when firstly, most of the market was driven by foreign money. What you've seen in the more recent past is it's being driven by domestic money. But I think what has also changed is the mix of domestic money. You had active domestic investors, and you had, well, let's call them passive or SIP investors or longer term investors. As you see that balance shift to the SIP side, I think the impact of it tends to diminish a little bit, because there was a point in time when everyone in the domestic market was trading and playing short term. That's no longer the case. So the impact to that extent will be somewhat muted, but there will definitely be an impact.
Okay, well, Prabhat, long term. Long-term capital gains on shares don't exist for shares that you hold over 1 year. Now, there is the broad theme that taxes will be cut when all exemptions are removed. Now, shares is the only one that is exempt from long-term capital gains in a sense. Land, any other form of assets, when sold, do attract long-term capital gains. So there is a philosophical underpinning to say that long-term capital gains need to be taxed in equities as well. What if that were to happen, however marginally?
So I think, well, you can debate this philosophically, because the fact is that what goes into long-term capital gains in shares is taxed. Essentially, you have taxes on income, you have taxes on dividends that the companies pay out. So actually, if you look at all the taxation in India, actually, most of the direct taxes actually come from companies. So to say that there is no long-term capital gains on equities, the underlying instrument, the profits which are generating that equity return are getting taxed pretty heavily, and the dividend, if you sort of look at taxes on profits, then tax on dividends, and then in hands of investors beyond a certain dividend amount, there's a whole lot of taxation which is going into this. But having said that, I mean, assume that there's a capital gains tax which comes in, it will be negative, because you need to adjust your returns accordingly. But my sense is that it'll probably be one time. It'll not be sort of one-time impact, and market will move on from there. Okay. We've had capital gains tax in this country before 2004. It will be negative simply because you want to get people to invest in equities and provide the risk capital, especially in an environment when you do not have capex. And the way you sort of raise capital is through markets. You want the markets to buy in. So In that sense, it could be a bit counterproductive because you want people to sort of raise money. The other thing that I would add is that, some of the countries which compete with us for capital, like for example Korea, etc., don't have capital gains tax. While the developed world might be having capital,
But many of them do have.
well, most of Europe and US has, but when talking of developing markets and whom we compete with, they do not have capital gains tax. So my 2 points simply is that the underlying shares, the incomes are taxed very heavily in India, and secondly, obviously we are competing with some countries which, so I would like it not to happen, but were it to happen, obviously the impact will be slightly negative.
Okay, but it would be one time, you think?
Yes, I would
wouldn't be a
think
killer?
Well, killer to the extent that whatever, you might see a downside immediately, but markets will just price it in once and then they'll move on.
Okay, I'll come back to you all time permitting on this issue. But Mr. Kapadia, the bigger problem that the market was suddenly confronted with on December the 21st and quietly withdrawn on January 14th was the CBDT circular. It has been held in abeyance. The circular basically saying that if foreign interest in any of the funds is over 5%, it will be considered material, and any transfer will be taxed not only at the hands of the fund, but also at the hands of the investor. Now, do you think that this budget has to give one way or the other an opinion on this? Amend the law to say exactly what it means.
I think so, and I think that's what probably will come, because the trend is clear, the action is clear. In the first place, it's a bit of a mystery why this circular was required a few days before the date of the budget, in that sense. And I think it's logical that, like they did for the MAT issue on FIIs, which ballooned up, this kind of an amendment and at least a clarification of 5% threshold increasing to a minimum of 26% is, I think, what should be expected. But Latha, just one comment I would like to make on the previous 10 minutes of discussion. My averment would be as follows. It would be tried to say that this government is not for the faint-hearted. So about 30 years, nobody dared to touch the Mauritius tax treaty, precisely worrying about spooking the markets, what will happen, etc., etc. And this is a government which took the bull by its horns, and as you know, in 1 year has not only amended Mauritius, amended 3 treaties. And well, there is no direct impact of that action on the markets. Secondly, I mean, demonetization, a lot of it has been talked about, but it's not for the faint-hearted. As I said, this is a government which is willing to take some risks. So all I'm saying is that I wouldn't be surprised if, if you step back, my point is this. I think the messaging which I see, the signaling which I see from government at this point in time is the dire need to increase the tax GDP ratio.
Okay.
That is long-term good for industry, for economy, for the market.
They will dare to impose the long-term capital gains.
Well, I don't know what the measures...
They may dare to increase short-term capital gains, you think?
I can't say what the measures will be, but all I'm saying is there will be demonetization is only the first of the steps. And my averment is that if the government is successful in increasing the tax GDP ratio from the 16% which it stands today to 18% in the near future and ultimately to 20%, frankly, markets as a consequence, everybody will benefit.
Okay. No, that point is taken. But gentlemen, I still have a couple of more questions to ask you all on taxes, especially on the corporate and the personal tax front and their impact on markets. We have to take a break. We are back in a jiffy with a lot more questions on what exactly will be the tax what will be the hope of the market on the personal and corporate tax front and how the markets might react. In a jiffy, we are back.